if the dynamics of the digital economy continue to run pretty much on a market-driven basis, then we're going to have large parts of society not only left behind, but losing in absolute terms. And that's simply because the fact of job displacement by smart machines, by smart systems, by robots or by AI systems is not only a prospect, but it's happening already. And it's happening at a pretty significant rate.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Will artificial intelligence wipe out millions of the jobs done by humans today? The AI CEOs tell us it's nothing to worry about. But one of the most influential living economists, as recognized by the Economist magazine, begs to differ. He says that AI is already starting to replace human labor at scale, and we don't have a plan for the aftermath. To discuss this very important topic in depth, we've got the great privilege of speaking today with Jeffrey Sachs, professor of economics at Columbia, best-selling author, and global leader in sustainable development. Professor Sachs, thanks so much for joining us today.
It's a pleasure to be with you. Thank you.
Well, thank you. And look, you have an incredibly busy schedule. We don't have a ton of time today. I've got a lot of questions for you. We're going to get through as many as we can, and that'll be it. It's been a little while since you've been on the program, and so just to kind of level set, I want to ask you a general question. What is your current assessment of the economy, both domestically and globally right now? We can get into the details, but at a high level.
Sure. Basically, things are very uneven within the US economy and globally. By that I mean we clearly have areas of remarkable dynamism in the US around the data centers and AI. This is a boom. It's a lot of capital is being raised and a lot of capital is being invested. This is generating growth in certain parts of the economy, certain regions, certain sectors, including the power grid, which is needed for the big expansion of all of this compute. Globally, we also have many parts of the world that are very dynamic, especially in Asia. But in the United States and in the world, there are also significant sectors and parts of society that are suffering. Clearly, just basic wage income is struggling. The so-called affordability crisis is really a crisis of stagnant or falling real wages. In the world as a whole, we have fast growth in East Asia and in South Asia. We have economic crisis and stagnation in other regions, a lot of Latin America, a lot of Africa. So the picture, and Europe is basically a rich and stagnant or even contracting economy. So the picture is unsettled, it's varied, it's a highly disruptive scene because of so many deep changes that are simultaneously hitting our societies. And there is therefore no one overarching reality. It depends on who you're talking about, which part of the world you're talking about, which sectors one is talking about. What we have is uncertainty and great variation.
Okay. I was going to do this big top-down international, down more into the micro US thing, but I'm going to pull up one of my questions from the end of my list here. So, mixed, uneven, as you said. A lot of people are saying, K-shaped economy, at least, here in the US. What is your outlook for that chasm of unevenness here? Especially because so much of the hopes of the future of the US economy are being pinned on the hyperscalers. on AI. I think the last time you were on, we very briefly touched on both the promise of AI, but also some of the risks, and a big risk being massive jobs displacement and creation of a large societal under/unemployment crisis. Um, are you feeling more hopeful at this point in time that the prosperity that we're gunning for will kind of lift all boats here in the US, or are you more concerned that it actually might leave that bottom half of the K, which really feels more like 80%, 20% is the up half of the K, 80% is the down? Like, is that 80% going to get left further behind here?
Well, I think we need to distinguish two things. If you ask, will market forces solve this problem? The answer is almost certainly no. If the dynamics of the digital economy continue to run pretty much on a market-driven basis, then we're going to have large parts of society not only left behind, but losing in absolute terms. And that's simply because the fact of job displacement by smart machines, by smart systems, by robots or by AI systems is not only a prospect, but it's happening already. And it's happening at a pretty significant rate. And what we're hearing is that many sectors of the economy, including a lot of skilled worker sectors, college educated work, uh, is now already finding that there are job freezes and so on. If you ask a different question, which is taking into account politics and redistribution of income and reorganization of society, could this technology lift all boats in uh, at the end of the day? I think the logic says yes. This could be a kind of breakthrough that is very, very broadly beneficial. Then you have to ask a third question. Are our politics on track right now to fulfill that role of underpinning a broad-based benefit of AI? And the answer certainly is no. Our politics are completely dysfunctional and becoming more and more dysfunctional. There's not even a rhetorical flourish in US politics right now aimed in the right direction. No one's asking the question, uh, in Washington, I mean, what do we do to ensure broad-based development? We're in a scramble for wealth. We're in a completely corrupt political environment of self-dealing all over the place, including the president's family and everybody else involved. So our politics are not aimed at the broader benefits, and the market dynamics, which will therefore prevail in the next few years, are going to be widening the income and wealth inequalities dramatically. Look, we have 10 people in the United States whose net worth right now is $2.3 trillion. This is incredible, really. That's a lot of money. An average of $230 billion for the 10 richest Americans. Those are all big tech uh, uh, super wealth holders. Um, they not only control that wealth and the companies, but they control their platforms, the media. They have all our data, and they control the White House and the Congress to a large extent. And they're absolutely not interested in the question of how to make sure that everybody benefits from all of this. They're scrambling in competition with each other. They want to have trillion-dollar paychecks. It's a very bizarre world where we don't know whether that upper part of the K is 10 people Is 1%, is 5%? It sure is not a majority of the public.
Okay, I've been actually using the term a lowercase I-shape economy that I think we're in the danger of moving to, where it's just this little dot at the top, very few people doing extremely well, far removed from the rest of everybody who's just getting left increasingly behind. Okay, so you are, I think, safe to say, concerned about the current trajectory here, and I want to continue tugging at the string real
Yes.
quick. Um, I'd just like to get your opinion on, yes, there's a big market opportunity that the hyperscalers are rushing after, but there also is a sovereign national interest that's been declared in AI, sort of akin to the nuclear arms race back in the 30s and 40s, where America is I believe, saying, look, we've got to win this. This is going to be the technology that lets America remain the superpower of the future. If we lose this race, say to China, that could dislodge us. Um, A, is that a fair characterization? And B, do you agree with that? In other words, we'll talk for a moment in a moment about kind of the repercussions of all this, but do we need to win the AI race as America?
Well, I think the analogy to nuclear arms is correct, and but that shows the fallacy of the claim that is made that we, quote, need to win this race. Who's the winner of the nuclear arms race? Nobody. We live under the nuclear sword of Damocles. We're at the edge of extinction. One wrong move, one mistake, everything ends. And believe me, if people think that's absurd hyperbole, they don't know what they're talking about. We live so close to the edge right now. We depend on not very smart people to keep the world alive.
Mhm.
We depend on there not being a terrible accident. Now, it's interesting to go back to the atomic bomb and the beliefs in it. When the atomic bomb was first exploded at Los Alamos, New Mexico, uh, and then used twice against Japan for no necessary reason, by the way, because the Japanese were trying to surrender at the time. But when it was used, American strategists believed that the US would have a monopoly on atomic bombs for at least a generation. They talked about 30 years. It
Mhm.
turned out to be 4 years. Uh, every calculation was a wrong calculation. When pushed by Teller, uh, we moved to thermonuclear weapons. We thought that that would be a lasting advantage. The Soviet Union matched us almost instantaneously in the hydrogen bomb. Then came the rapid proliferation of these weapons. Then came a rather desperate attempt led by President John F. Kennedy uh, initially to try to get this under control, starting with the 1963 Partial Nuclear Test Ban Treaty, and then the Nuclear Non-Proliferation Treaty, then a series of arms control agreements between the United States and the Soviet Union. Uh, and in other words, the idea of American officials was, we'll win this race. And then they realized, no, there are no winners. We are going to get ourselves blown up if we don't get this under some kind of mutual control. Uh, by the time there has been some control, there are nine nuclear countries right now, and nothing's really under control, I would say. Our situation is extraordinarily fragile. The Bulletin of Atomic Scientists puts out the doomsday clock, which is the visual representation of how close we are to disaster. And the doomsday clock is set at 89 seconds to midnight, meaning the closest we've ever been in the whole atomic age or nuclear age to nuclear Armageddon. So now to come to AI, what you expressed is absolutely the view in Washington. And I happened to listen a few years ago to a chillingly stupid discussion of two NATO generals at one of these strategic conferences that I attended once in a while. And they were saying to each other, yes, we must win the AI race with China. We're going to win. We're going to do this. Uh, this is so naive. China produces so many more PhDs than we do. Just the scale difference is vast. The talent is enormous. And you get advances in the US and then something we never heard of before called DeepSeek comes along and says,
Hmm.
we're here. And then suddenly you have all over China, top flight, top performing LLMs. And then the United States says, oh, we've got a chokehold on 2 nanometer chips, on NVIDIA chips. And then you get almost weekly a report of some new computer architecture that does an end run around those chips. The United States has some monopoly on this. Are you kidding? This is ridiculous. Of course it doesn't. Are we going to win the AI race against China? No. Are we going to lose the AI race? No. This is not that kind of thing. This is not, you know, this is not a race. This is a core technology in which there's going to be a lot of expertise all over the world. The idea that we're going to have some chokehold over this is absurd. So let's get it out of our heads at the beginning. And then we should ask, so given the analogy with nuclear arms, where is this dangerous? What should we do about it? And what should we do diplomatically about it? We should move more quickly to that. With the nuclear arms, we did not get to even the first treaty, the Partial Nuclear Test Ban Treaty, until 18 years
Hmm.
into the atomic age. Can we do a little bit better than that this time? That's what I hope.
Okay. Well, I'll add my hopes to that. The reason why I asked the question, I think you answered it, is while you and I have that hope right now, it doesn't seem that that's at the forefront of the mind of the folks in Washington, right? So,
Not at all.
right. So we have these sort of twin engines propelling the AI build out, both the market, the size of the market opportunity. So the capitalists are sprinting after that. And then the state sector is saying, look, we're going to do everything we can to clear the playing field for you because we want to win, right?
And
So,
and I would add one more very
yeah.
obvious and specific point, which is that it's not that we want to win the economic race. It is that the Pentagon is salivating. We need AI in all our weapon systems. So
Right.
this is becoming completely a national security tool as well, or what they call national security. I would call it national insecurity, because everything we are doing is raising our insecurity. But this is an extraordinary technology because it is at once everything about the production processes of the economy. So AI is becoming embedded in all production processes. It's embedded in the service economy. It's embedded in our online lives automatically. Uh, but it's also it's embedded in our media, which happens to be owned by these very platforms, whether it's Meta or Google or
Hmm.
Microsoft. So they own the media, they own the platforms. It is mortgaging our privacy because they actually own our keystrokes also in ways that I can't really understand, but I know it's there quite obviously. Um, and it's also, they own the White House. They appoint they appointed the vice president, for God's sake. They told Donald Trump who his vice president was going to be at a dinner in San Francisco. Uh, it's not even subtle, this stuff. So they own the politics. And unlike the nuclear arms, by the way, where basically, in a way, the generals just pushed away the atomic scientists after a while, or hired some of them, uh, but said, we own this. Uh, the Pentagon doesn't own AI. This is owned by Peter Thiel and Elon Musk. The Pentagon is contracting out to these companies which hold the technology now. So this is really an extraordinary concentration of private power. And you add in, yes, they're making way for all of this. Um, uh, but they're basically turning over politics, national security, mass media, the payment system, by the way, which is going to be a digital crypto something or other payment system that maybe they'll let us know about at some point, and all of our media. So
Right.
pretty
They're
pretty
putting it into
unusual.
the hands of private jets. It's almost sort of
Yes.
the Tony Starkization of the economy, if you get the reference from the Marvel movies.
Yes.
Okay, again, I think you're proving the point I'm trying to make here, which is this is a juggernaut that is in motion and perhaps even still building momentum. So, as much as you and I would like there to be more cautionary, steps in here, probably not going to happen anytime soon. Which gets us to okay, so probably doesn't bode pretty well for that bottom 80%, right? Like we might get cheaper entertainment. Okay, hooray! Maybe we enter the Ready Player One era where we get free VR goggles and we can spend all our time in the virtual world. But we're out of jobs. We're out of purpose. We're out of power on a relative basis because it's concentrating in that dot of the lowercase die-shaped economy that we talked about. So I guess a lot of concerns around that. Now, you had said there's a way to do it differently. And I guess first I just want to imprint on the listeners that a really smart gentleman like yourself, who's very connected and studies all this stuff, is quite worried about where society could go here. And maybe I might ask you just to make a comment or two on what you think that future looks like, where the bottom 80% get even further dispossessed from here. And then secondly, I'd like you to talk about your vision of how we could do it differently. And I guess where I'm going with this is what I hear from the AI fanboys is, hey, AI is going to create a lot of jobs as well. Maybe, but I think on a fractional basis, it's going to be a lot fewer than it's displacing. So they say, well, even if it does, we'll have universal basic income and everybody can go focus on being their best selves. I think history is pretty clear. It's my opinion. You might feel differently that giving people a subsidy to basically do nothing creates a dependent class that ends up investing more in their vices than their virtues. So in the better way we do this, if technology is still doing all the work, how do we make this more equal? Is it just redistributive policies, or is there something in here that gives the bottom 80% a role?
Well, first of all, I don't know the answers to this, and I don't think anybody does. I haven't seen or
Right.
heard anything that I find accurate and compelling that says that is how the future will play out. So I just want to caution on that obvious point at the beginning. Second, we've been in the midst of related changes for at least uh, 60 years. Uh, Automation became a thing, a noticeable thing in the 1960s.
Mhm.
It became a matter of a lot of public discussion already 60 years ago. And that was not wrong to worry about that because what we've had during a 60-year period is a bifurcation of society into three parts now. One is the the super uber haves,
Hmm.
those who have more than is absolutely imaginable. And then the successful haves, which is broadly speaking, the professional class in America, typically people who have had an advanced degree of some kind, an MBA or law degree or medical degree or other professional degree. And the broadly speaking, somewhere between the high school completion and bachelor's completion, depending on a lot of specifics, but finding stagnant wages by and large, and very big difficulties of accumulating wealth. Uh, and one of the most evident of those difficulties is homeowning for young people, which
Hmm.
is deemed to be a pretty widespread crisis for a lot of young people. So we've already trifurcated, you could say. We already have three different groupings in society that live very, very different lives. If you ask my cohort in the professional world, how are things and how they've been over the last 20 years? Yeah, good, very good. Good incomes. Stock market's been going up. Lots of new opportunities. Tech has been good. Feels all very good, actually.
My house
If
goes up in value every year.
Yeah,
Yeah.
if you ask someone who basically doesn't have saving and if they've been very unlucky, but that's a lot of American people aged 25 to 50, um, had a high school degree, went to work, lost their job, and so forth. This is not easy. Healthcare costs are soaring, hard to save anything. What's called the affordability crisis is really, again, a stagnant wages crisis that comes from the fact that basic jobs have been under uh, replacement dynamics for decades, not just now. It's not just AI, it's robots, it's smart systems of many kinds that have been
Hmm.
operating. So we're already in the midst of this. What is interesting is that and it showed up in some, everybody understands this now, I hope, in some very dramatic ways, life expectancy gaps between having a university education and a high school education is 8 or 10 years of life expectancy. Can you imagine this? Completely different lives within our society. And what is interesting, it's a strange word, but if you're an analyst, our political system to this day hasn't reacted to this. Uh, Really, we have been in a kind of paralysis. We had, for example, a huge fight over Obamacare. Obamacare is a half of 1% of GDP. It's a tiny little change of the national income. It was, full out war for a decade in the political system. In other words, our political system is paralyzed, unable to address big issues like the changing income distribution according to educational attainment. And now we have a different changing income distribution. It's not really most likely between skilled and unskilled or high educated and lower educated. It's actually more broadly between those who have financial wealth and those who don't. Because stock market has, maybe there's some bubble in it, but it's been booming in part because more and more national income goes to profits, goes to the returns to patents, goes to software, goes to the monopoly or oligopoly ownership of a few digital platforms. And if you happen to have enough income that you have been saving out of that income and you've been investing in your in your retirement accounts and so forth, you've been a beneficiary of that wealth. But if your income has been so low that you're, my God, still trying to pay your student debt or trying to pay an unexpected healthcare emergency, you don't have wealth. You haven't benefited from the shift of national income from wages to profits. You've lost from that. And so we are now in an intensifying phase of this growing inequality. And I don't see the slightest evidence at all, no evidence right now, that Washington's on the case. I don't hear one word about it. I don't hear even a conceptualization. The Democrats, I mean, it's stupid even to say they don't represent, they don't represent the workers, but MAGA doesn't represent the workers either. The whole thing is shambolic. Both of them, Democrats, if they represent any class, they represent professionals. And MAGA represents the Trump family and his friends. And so we don't have a politics of facing up to this question. We have no serious discussion. We don't even get to your question of is there a better way than redistribution or pre-distribution to address this? I'm pretty sure, by the way, that part of the answer is actually what we would call pre-distribution, which is that at least everybody gets education with quality and healthcare with quality, not out of their personal consumption spending, but out of their citizenship. I do think that this is absolutely right, that we have, as a matter of citizenship, that you can get your health care without needing a MD or PhD to understand our healthcare system, and without having to, go into irreversible indebtedness to pay your medical bills. But we're not even there at that point yet.
Okay, Professor Sachs, I have so many questions for you, but we're running out of time, so we'll just have to reserve them for the next time. To kind of land the plane here, I hear you say, look, problem's big, maybe intractable. Our
No, I
political
don't say
system.
intractable.
Well, you
I
didn't
just
say
say
okay,
big,
yeah,
big,
yeah,
big,
okay,
big.
but very, very big. Say in the near term, it might feel intractable, and our political system is not going to ride to the rescue anytime soon.
Our
So,
political system, as it's now constituted, yes,
as it's now constituted, yes.
yes.
So, I mean, there's so many questions that the audience would like me to ask you here, but just to make it practical, for somebody watching this who is saying, whoa, this feels really heavy and kind of depressing, do you have any advice to them to at least say, look, here are some things you could think about considering so that you are less likely, you're reducing your odds of being collateral damage to all of this if this juggernaut continues for the next 5 to 10 years?
Yeah, let me just say in the long picture, which is not a very satisfactory answer, but it's also important to understand this is not a new phenomenon in some fundamental way because big technological breakthroughs have not only expanded the pie, but have repeatedly uh, reshaped the distribution of income, usually in an unequal way at the beginning. So I just want to make the following point. When the
Like
industrial,
the railroads, good example,
yes,
right? Maybe we had the robber barons, but then everybody
exactly.
benefited. Yeah.
When we had the Industrial Revolution in the 19th century, uh, the first half of the 19th century was very tough for those who were found themselves in grim Dickensian circumstances in the new factory towns. It was miserable. And that's what gave rise to the Communist Manifesto in 1848 and gave rise to the idea that there needs to be a proletarian revolution and so forth. 50 years on, it took a long time, but there started to be a more general rise of well-being, partly from market forces, but a lot through politics, what we call the populist movement and then the progressive movement, and the reforms that came with that. And then the culmination of that in the United States was the New Deal under Franklin Roosevelt. And that brought in Social Security and many other broad-based measures to say we need to share this growing bounty. And of course, FDR talked about 1/3 of our nation ill-fed, ill-clothed, ill-housed, and that the U.S. was a rich country with a lot of poverty, and we should do something about it. And my view is FDR was our greatest president in our country's history for taking this on, as well as for many other things that he accomplished. So politics did come through in the end, and the basic idea, you have a larger pie. If politics works, everyone can be better off. I want to say that that is a logic also that applies to these new technologies. I really like them. I think they're incredible. I think that they raise productivity. I think that they do all sorts of good things. I despair of our corrupted political system, our corrupted politicians, our corrupted chief executive. This is not how our country should be. It's not intrinsic to the technology, is what I'm saying. We can get to these reforms. At some point, our country will figure out, it really will figure out, it's not right to have someone asking for $1 trillion paycheck. That's just not right, Elon. It's not right having 10 people who have $2.3 trillion of wealth. An interesting part of the politics is the concentration of wealth and power is so extreme that actually the vote is overwhelmingly against them. You don't have to be the median voter. You have to be, like you said, in the 80th percentile or the 90th percentile to say, to hell with this, come on. And so this gives me some optimism that some political entrepreneur is going to wake up and say, look, why do we all feel poor when we're in a booming technology? Well, it's because it's all going to those few people who think that they own the shop. And then we could actually start to get some real reform. So I find it distressing and disturbing watching our politics. I find it really shambolic. But I'm not completely pessimistic because if it's just 10 of them, well, we're 350 million. We ought to be able to figure that one out.
Right. We outnumber them. Yeah.
Yes.
And that's good to end on. So you're saying, look, while it may feel dire, and it might be dire for a while, maybe even a good while, you don't think it's the end of the American experiment? We've been through technological cycles like this in the past. I will note the one question I didn't raise in here, which we won't inject in the conversation, but it's just, yeah, but provided AI doesn't kill us all, at some point in here, the Terminator, risk here, but that's a discussion for a different day. Professor Sachs, I very much appreciate you doing this, especially under such a tight schedule. Very enlightening, sobering, but important conversation. Really appreciate you having it just out in the open like this. Last question for you. For folks that would like to follow you and your work in between now and your next appearance on this channel, where should they go?
Oh, thanks a lot. I have a website called jeffsachs.org. Please do that. Every day there are deep or not even so deep fakes of me all over all over the websites right now because this is another part of AI. I'm hearing all sorts of things about speeches I never gave and so forth. So if you want the real thing,
stuff,
it's at jeffsachs.org.
Fantastic. And when I edit this, I will put that up on the screen so
Excellent.
Folks know exactly where to go. Folks, the link will be in the description below the video as well. All right. And lastly, folks, please join me in thanking Professor Sachs for giving so much of himself and the time that he had here to us. I extend that thanks by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And if, he gave us an awful lot of food for thought here. If you would like some professional help from a professional financial advisor on trying to think through the repercussions of the direction of the AI juggernaut, what that might mean for your portfolio, ways to perhaps maybe take advantage of it to, if there's going to be a winning team in the near term, at least make sure you're on it, and also make sure that the other parts of your investment might be better insulated from some of the risks. Then if you don't have a good professional financial advisor already advising you on all that, feel free to talk to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule a free consultation with them, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. Again, these discussions are totally free. There's no commitments involved. It's just a service they offer to be as helpful to as many people as possible. Professor Sachs, again, I cannot thank you enough for giving so much of yourself to such an important topic, talking about it so frankly, and giving us so much in the limited time that you have. Really appreciate you making the time for this audience.
Great to be with you. See you again soon.
Now we're just starting another leg, which I think will be at least symmetrical to the prior leg. So we had the move from under 300 to 1900 consolidation. That was a six-fold increase. If you assume we go up six-fold from 2000, that's $12,000 gold. So I kind of, at a minimum, I think that that's where we're headed. But if we end up having a dollar crisis and a U.S. sovereign debt crisis, we can go a lot higher than that. There's a good chance that that's going to happen. You asked me what's driving this. It is the monetary and fiscal policy of the United States, which are disasters. Once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months.
Gold can rise dramatically, potentially reaching $12,000 if the next leg matches past gains, with even higher levels possible in the event of a U.S. dollar or debt crisis. They attribute the rally to America's poor fiscal and monetary policies. For silver, once it breaks above $50 and holds that as support, they expect a rapid surge toward $100. Peter Schiff, the speaker, is a prominent financial analyst, economist, and CEO of Euro-Pacific Capital. He contends that the Fed's rate cuts in the face of growing inflation are contributing to the increase in gold prices. Mining stocks rose 30 to 40%, indicating that investors are now embracing gold's power. In an effort to lessen their dependency on the US dollar, which would make it more difficult for the US to pay for imports and debt, central banks are purchasing gold. Gold is a useful substitute for fiat money since it can be easily utilized for payments through tokenization or digital systems, thanks to modern technology. Gold is the real money of the free market since it maintains and even increases worth over time, unlike currencies, which depreciate. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
And I think that's really what's helping to drive the move in gold now and down in the dollar is the Fed is about to start cutting rates into rising inflation. And it's hard to imagine when they've done that before because inflation is above their target and rising, and they're going to cut into that. So it's the opposite of what they should be doing. Even though the economy is weak, inflation is strong. And that should be the primary mandate, is to get inflation back down. But they're going to abdicate that role because of the political pressure to try to artificially stimulate the economy, the housing market. So gold is going to take off from here. We basically just left the launch pad. And we got a long way to go. But, the whole time that gold was going sideways for 3 or 4 months, gold stocks were quietly going up. Gold stocks went up 30, 40% while the price of gold traded sideways. And that's something we haven't seen during the entirety of the bull market because the investors in mining stocks have never believed the rally. They've been skeptical the entire time. They're finally starting to accept the fact that gold's not going to crash. But these gold stocks are not priced for current gold prices, let alone the future gold prices, but at least they're pricing out a crash now. People accept, okay, gold's going to be around this level. So we got to bid up these stocks because they're still really cheap, even though they're up better than 90% on the year. And gold mining stocks are the number one performing sector in the market this year, and they're hardly ever discussed. No one talks about them.
Well, I think that is going to happen. I think it's pretty clear. If you look at the main buyers of gold the past couple of years, it's been foreign central banks. Why are they doing that? I think they're preparing to replace their dollars with gold. I think gold is going to become the primary reserve asset for central banks. And that's going to be a game changer for the United States because the world is not going to need our dollars anymore. Well, if they don't need our dollars, then how are we going to buy all the stuff that we need because we don't produce it? And how are we going to finance our debt? Because we've been relying on foreigners to finance that debt because they have the savings that we lack. So it's a big problem for the U.S. But I think from a monetary perspective, you're going to see, I think, people utilizing gold using the technology that exists today, whether it's on-chain with, tokenized versions of gold, or whether it's just through proprietary closed systems where, the custodian has the gold and just uses technology to allocate ownership digitally so that people can transact business, receive and make payments, send money and receive money using gold, right? Just like using PayPal or Venmo or any other, Zelle or any of these things, you can just use gold. You don't have to transfer your gold. If I wanted to buy something from you and you wanted me to pay you, a gram of gold for it, right? Whatever that is, 30, 40 bucks, whatever, right? I don't have to send you a little bit of gold in an envelope and mail it to you. If the gold is held in a custodian and I have it tokenized in my wallet, I can just email or text you the gram. And now the ownership of the gold goes from me to you. So now you own the gold, not me anymore. You've got it. It's in a vault. Now, if you want the gold, you can have them ship it to you. But why do that? Just hold on to the ownership receipt, because now if you want to buy something, you can pay with gold, because the guy that wants to sell you that, he wants gold too. Why would people prefer gold to dollars? Because gold holds its value. Why would I want dollars when I can have gold? It's like, why use the post office when I can send something by FedEx, right? The free market has provided me with a better alternative than the government, right? Why do people use Uber and Lyft? Because taxis are too expensive. Why are taxis expensive? Because the government provides the licenses and regulates them, and so they're expensive. The free market alternative is, well, I'll just call an Uber, right? So the equivalent of an Uber in the monetary system is gold, right? Gold is the free market's money. Fiat is government money, and it's lousy because it loses its value. The longer you hold it, the less it's worth. The opposite is true of gold. The longer you hold your gold, the more it's worth. So given a choice, which would you hold?
According to Peter Schiff, the $50 mark, which was last attained in 1980 and 2011, is a significant barrier for silver. He anticipates a sharp increase to $100 once it breaks above because shorts will have to cover. This was largely driven by global industrial demand, which, according to the Silver Institute and Metals Focus data, rose by 4% to another record of 680.5 million ounces in 2024. For the time being, he would rather Wall Street remain closed so that his clients can purchase gold and silver equities at a discount. Despite extensive marketing, Bitcoin has underperformed gold for years. He suggests purchasing gold mining equities in addition to actual silver since he believes they are still cheap. He prioritizes selling gold at modest markups over expensive items at his business, Shift Gold. He cautions that it is dangerous to wait for dips because prices are rising and a reversal will probably occur from much higher levels by then. Let's get deep into the interview.
Very realistic. I mean, especially if you have $10,000 gold, $200 silver, what is that, 50 to 1? I mean, so that's very realistic. And I think potentially silver could go higher than that. But right now it's above 41. It does have this psychological, and not just psychological, real resistance at 50, because we have a double top there.
that goes back to 1980. And then again, we hit it in 2011. So silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months, right? Because once we take out that resistance, there's nothing there. And I think there's also a lot of shorts out there in silver that, are going to be in a lot of trouble trying to cover those shorts and buy silver that really doesn't exist. I actually like the fact that this bull market isn't on anybody's radar, because I just assume Wall Street buy into the market later at much higher prices. They don't need to get in now. I want my clients to get in now. And the less competition, the better. I just want to get as much, gold mining stocks and silver mining stocks as I can. And the last thing I want is, Merrill Lynch and Goldman Sachs telling all their clients to buy, right? Because that's going to make it more expensive for my clients. So the longer they ignore this bull market, the better, as far as I'm concerned. Like, I'm in no hurry. I waited plenty of time for this, and I'm in no hurry to speed it up right now. But I do look at that as a positive sign that nobody's invested. The public, has no idea. You have one group of people that are still fixated on Bitcoin, and they're buying Bitcoin instead of gold. Although Bukele, I just read that he just put $50 million into gold. So maybe he's figuring out that Bitcoin is the wrong way to go. But, it's interesting that Bitcoin is barely up today, and Bitcoin is more than 15% below its peak priced in gold from 2021. So 4 years, Bitcoin's been losing value relative to gold, despite all the marketing hype surrounding Bitcoin, all the ETFs that were established, the NFTs, the Super Bowl ads, the celebrity endorsements, Donald Trump and the strategic Bitcoin reserve and the Bitcoin czar and making Bitcoin the capital of the world, right? All that pump, and they can't even get Bitcoin to go up. So what does that tell you? But what is going up is the one thing that's not getting any hype, and that's gold. And now silver, going up as well, but not into record territory. So these gold stocks, I think, are still extremely cheap. They could double again from here, and I don't think they'd be expensive, especially considering that if the gold stocks double from here, gold's going to be a lot higher. So it's like they still wouldn't have caught up to where they should be. So we got a long way to go in the mining stocks. In fact, in April of this year, I kind of aggravated some of the guys at Shift Gold because I put out this report that said the best way to buy gold, and it was to buy the gold mining stocks. And I was telling my clients for the first time not to buy gold. And gold was around 3,200, 3,300. And I said, look, I'm a gold bull. I love gold, but these gold stocks are so cheap that it doesn't make any sense to buy gold above ground. Just buy it while it's still in the ground because it's so cheap. And while gold went sideways for all those months, the gold stocks were soaring. And they're not as cheap as they were, obviously, but they're still very cheap. And I still think people should be buying gold stocks and gold now, and physical silver and these silver miner stocks. So, Shift Gold is my gold company. What you want to don't do, there's so many, unfortunately, shysters in the gold industry. And they rip off their customers by pushing them into these numismatics or collectible coins, fake numismatics, proof sets, odd weighted, coins you've never heard of. And they do that because the markups are 30, 40, 50% or more. And so you need the price of gold to go up 50% just to break even. So why buy gold at 3,600 if you need 5,000 just to get out even? So at Shift Gold, we're marking up gold like 1%. So if you bought gold yesterday, you can sell it back today and make a profit, right? So you don't want to get ripped off. So going to Shift Gold, you're going to get the best prices. You're going to get just bullion. We're not going to try to push you into something that makes us money. We're going to sell you what you need to make yourself money. My goal is to make a little money on volume,
not on ripping people off. But that's also interesting. Like Shift Gold's phones are not ringing off the hook. I mean, it's slow, and that's the same throughout the industry. And what the Shift Gold guys have been telling me, our reps, is that customers have been reluctant to buy because they're worried about buying the high. And I've been telling our customers all year, you got to buy the high because that's all that you're going to have the opportunity to do. The problem is the longer you wait, the higher the high is going to be. So you just might as well buy now. I mean, because you're not going to get a big enough pullback. You'll get some pullbacks, but why wait? It's not going to be enough to make a big difference. And the risk is that by the time you get a pullback, it's pulling back from a price that's much higher than if you just bought it right now. I don't see any panic to buy. Gold's not moving up $100, $200 a day. I mean, that's going to happen. I mean, it moves up $10, $20. I mean, today, $50 is a big move because we got data. But, I haven't seen anything crazy. The gold stocks go up 2%, 3%, maybe 4% in a day. Then they pull back. They're not up 10% in a day. They will be eventually, but we're not there yet. So, people should get on board on the mining, on the metal at Shift Gold. And gold stocks, my gold fund, I'm very partial to my gold fund that's managed by Adrian Day. But I think that the hidden value in my gold fund is our portfolio of very small junior miners that would be almost impossible to buy today, given the liquidity. But these stocks haven't moved the way the big ones have because the money that has been flowing in has been buying the Newmonts and the Barracks and the Agnico Eagles and the Franco-Nevadas and Kinross and IM Gold. I mean, they're not buying the little ones.
Peter Schiff's outlook underscores that gold and silver remain deeply undervalued in the current environment. With central banks diversifying away from the dollar, inflation eroding purchasing power, and precious metals poised for technical breakouts, he believes now is the time to accumulate gold, silver, and mining stocks before Wall Street and the broader public catch on. Do you think silver will finally break its decades-old $50 ceiling in this cycle? Will gold's rise to potential new highs force central banks to accelerate their shift away from the US dollar? Share your thoughts on Peter Schiff's analysis in the comments section below. If you find this video informative, please consider supporting us and turning on notifications to stay updated about our latest videos. See you in the following video. Thanks for watching.
In the bust, most assets are going to go down other than treasuries. But so gold will correct. If 4,000 were the high, and it may not be, could just as easily be 4,500, but if 4,000 is a high, you could be back to 3,000 or below in the bust. People want a target in the bust. I go, we don't even know what the high is on the way up. So, but it'll get hit by, 30% or more probably. Silver, if my target on silver is 75, if we correct from 75, that is more volatile, so that could go down, back into the below 30 or back into the 20s. So they're not going to be straight lines. In both cases, I think this is important. In both cases, in the post-bust era, which is 2027 and beyond, I believe you'll see gold probably in the early 2030s, and silver, same time frame, gold to 20,000 and silver to 500. So
the outlook suggests that during a coming bust, nearly all assets except treasuries could fall sharply. If gold peaks around $4,000 to $4,500, it could correct by 30% or more, potentially dropping back near $3,000. But Goldman Sachs says gold could hit $5,000 under scenarios like political threats to Fed independence. Meanwhile, silver, being more volatile, might fall even harder. If it reaches $75, a correction could send it back below $30. These moves won't be in straight lines, but in the long run, especially from 2027 onward, the forecast is extremely bullish. Gold could reach $20,000 and silver around $500 by the early 2030s. David Hunter, a precious metal expert, points out that gold recently broke out of its consolidation range around $3,300 to $3,400, pushing to new highs, with targets now raised to $4,000 and possibly higher. Goldman Sachs warns that gold's price could increase dramatically if the Trump administration's attack on the independence of the U.S. Federal Reserve is successful. They say that would trigger a flight from traditional safe havens, assets people run to when markets get shaky, traditionally, the U.S. dollar. Forecast already predicts gold reaching $3,700 by the end of 2025 and $4,000 by mid-2026. The result of their expectation that central banks will continue their current gold buying spree. On the other hand, silver has been even stronger, up nearly 50% since April compared to gold's 21%. David mentions key drivers include a weaker dollar, falling interest rates, geopolitical tensions, and heavy central bank buying, all reinforced by strong momentum now attracting institutions. The dollar, down from 110 to 97, could drop further toward 82 in steep steps. With the Fed just beginning a rate-cutting cycle that could bring rates near zero over the next 18 months, both gold and silver still have significant room to run despite cautious sentiment in markets. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article.
Absolutely, and I do say gold was in a consolidation from basically April till recently, and it broke out, from 3,300, 3,400, broke out here, and we're at new highs again. I raised my target to 4,000 last year, or not last year, I think a couple letters ago, and I'm not going to be surprised if that proves to be low, or conservative. So I'm very bullish gold here. I'm even more bullish silver. Silver's had a great run. It's up. I just did the numbers yesterday. From April to now, gold is up 21%, I think, and silver's up 49%. So it's quietly, people haven't really noticed, but it's quietly outperforming gold as it does in a bull market. So I think silver has a long ways to go. Gold probably has a good ways to go too. So I think the weaker dollar is certainly part of that story. Lower interest rates is certainly part of that story. Global unrest and global uncertainty is certainly part of that story. And the central banks around the world gobbling up gold is certainly a piece of it too. So, and then the final piece, which people always underestimate, is the power of the momentum. It's all of a sudden the institutions are starting to notice gold, even though it's been running for years. Because it's got that momentum now, they're starting to say, hey, we have to have a piece of gold in our portfolios. Not low. I mean, the dollar's fallen from, basically 110 to 97 in a matter of a year, probably, or less. And I think it's my target is 82. That's far below here. It'll happen in some pretty steep steps. So the first step down in, the mid 90s, and then you consolidated here. I think the next step down takes you down through 90, and then the third step down to 82. So I'm not surprised at all. You have to go through consolidations when you have such a big decline. It then goes the other way for a little while. You have to convince some of the people that were jumping on the bandwagon, but not with conviction, that whoops, this thing's going the other way. So I think we've just pretty much gone through that consolidation, and now we're beginning the next leg down, and I think it could happen pretty fast. Well, think about that. I think that tells you the sentiment that's on the street. Everybody's got including yourself just there, everybody's got a foot out the door saying, when do I exit, right? And so what we've had here, we're just beginning an easing cycle. If the Fed is truly just beginning to cut, and that there's going to be many, many cuts between now and the end of next year, where you could see the Fed fund rate go from 4.25 here down to even zero. They don't know that yet. They have no idea that's what's coming. But if in the next 18 months that's what you're looking at, and you're early on in that, and you're at a point where it doesn't look like the economy's falling out of bed, gold's got a ways to run, silver's got a ways to run, the stock market's got a ways to run, and yet everybody's getting nervous here rather than bullish.
A few years ago, David called for a major market melt-up and has steadily raised his targets as conditions improved. His S&P 500 target has climbed from 6,000 to 8,700, with Nasdaq at 30,000 and Dow at 60,000. He views this as the tail end of a long bull cycle that began in 1982, likely topping out soon, but still with strong upside left. Despite a slowing economy, falling interest rates and steady earnings are fueling gains. Interestingly, retail investors have stayed confident and bought dips, while institutions were more cautious and even bearish, only now starting to turn more aggressive as they see the market's momentum. Let's look back at the interview.
Probably 3 or 4 years ago, because I was calling for this melt up, and I get accused of raising my targets constantly. I go, that's what you do. As the evidence proves it's got more, there's more things saying it should go higher, you raise your target. So, I started out at 6,000 or even before that at 4,000, but I've raised it to, 7,000 and 7,500 and 8,000, now 8,700 on the S&P. And same thing, I've raised my gold target a few times. But it's the case that this thing is a big historic bull market. You just gotta stay with it. I'm sorry, I lost my train of thought of what you would. Oh, we were talking about the VIX. Several years ago, I said the VIX could go to 10, and that was when it was in the 20s. I said if we've got, and that was when I thought the market might go to 4,800, 5,000. I still would say that the low on the VIX, I think, is down just below 10. I think that's probably where we're headed again. So everybody gets worried when it gets down at 14, 15. I go, it can keep going, and there's no magic at 10. If it wants to go lower, it's really, it's a trading vehicle. There are times when it the market goes through a swoon and it bounces back up over 30 and maybe over 50. But other than that, I don't use it at all to say this is the top in the market, because it can go lower. We are, as I've been saying for a long time, I think we are late in a long cycle, a bull market cycle that started back in 1982. So this is the 43rd year as of August of a bull market cycle that I think is coming to an end. I expect to see, we probably could top out by the end of this year or sooner. But we've got, I raised targets back in April when we had Liberation Day and everybody got bearish. I raised my target to 8,000 on the S&P. From there, in my July investment letter, I raised my target to 8,700 on the S&P, 30,000 on the NASDAQ, 60,000 on the Dow, and the Russell 3,400. So I obviously think there's still a lot to go here, even though I think it's going to happen pretty fast. It is late in the game. We've had a long cycle. The economy is slowing. We may, in fact, already be in recession, but at this point, the evidence is not building to something that says I'm calling for a global bust next year, as you know. But the evidence right now allows most investors to see this as a soft landing, and earnings are still intact. So basically, you've got the best of both worlds: slowing economy, what I think are going to be declining interest rates, and earnings still growing. And that's music to the ears of Wall Street. That will get all the skepticism that's built up on Wall Street. They've fought this market since 2022, all the way up. You're starting to see them begin to say, "Hey, I gotta get more aggressive because this thing has legs." People, it's not that institutions go all in or all out. They're probably not very much in cash, but they're more defensively positioned. They have been skeptical towards the market. You're right. The retail investor, surprisingly, when we had that swoon back in April, they stayed in the market pretty much, and said this is a buying opportunity. It was the institutions that jumped on the bear market bandwagon and said, "Oh, we're going lower. We're going a lot lower." Strategists across Wall Street were lowering numbers and talking about 4,000 or 3,000 on the S&P, and it was surprising to see the retail investor stay basically on board and bought down there. Like I said, at the very bottom of the sell-off in April, I raised my targets while everybody else was lowering their targets. So, kudos to the retail investor that they this time were the smart money, and it was the institutions that weren't so smart.
Both gold and silver are showing powerful momentum, supported by central bank demand, a weakening dollar, and shifting global policies. While sharp corrections are possible if gold peaks around $4,000 to $4,500 and silver near $75, the long-term outlook remains extremely bullish, with forecasts of historic highs by the early 2030s. At the same time, equities may still have room to climb, even late in the cycle, as falling interest rates and resilient earnings continue to provide fuel. If a sharp correction does occur, would it present a buying opportunity for long-term investors or a warning sign of deeper risks? How much influence will central bank gold buying have in preventing deeper pullbacks in the years ahead? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
I think that the precious metals rally is saying that inflation was much higher than what the government was publishing in terms of CPI. The gold price is reflecting collapse in the purchasing power of money. And now the gold price is probably reflecting the cost of living increases between 1971 and today, rising strongly. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. Gold would be a reasonable alternative.
The recent rally in precious metals like gold, silver, and platinum likely reflects much higher real inflation than official CPI figures suggest. Since the US left the gold standard in 1971, the purchasing power of the dollar has collapsed, and gold's rise is tracking the true increase in the cost of living over time. Ray Dalio says markets risk a hard attack from rising debt costs in the US and suggests holding 10 to 15% of one's portfolio in gold as protection. Moreover, Goldman Sachs warns of this scenario. The idea is that political interference could damage trust in traditional assets and the dollar, making gold more attractive. In the near term, new highs in metal prices are possible, and gold remains a strong long-term store of value. The speaker, Dr. Mark Faber, often called Dr. Doom, is a Swiss investor, economist, and market commentator. Gold's rise since the US left the gold standard in 1971 reflects the loss of money's purchasing power and higher living costs. Markets don't move in straight lines, they surge, correct, then resume upward. Over 10 years, gold would be a strong long-term choice compared to stocks or bonds. Gold is up nearly 40% this year, outperforming most assets as Fed rate cuts, a weaker dollar, central bank buying, and inflation fears drive demand. Forecasts put gold between $3,700 and $4,000 by mid-2026. Treasuries remain debated, with long bonds seen as fragile, while short bonds or cash offer optionality. Still, gold and miners are favored amid economic and policy risks. In downturns, gold is viewed as insurance. Mark Faber specifically mentions the mining stocks like Barrick and Newmont. Barrick is streamlining by selling non-core assets to focus on top gold and copper projects, though production and regulatory risks remain. Analysts view it as undervalued. Newmont has been upgraded to outperform for its turnaround, strong cash flow, and leverage to rising gold prices. Both miners are seen with significant upside, potentially doubling if gold's rally continues. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the video.
The gold price is reflecting the collapse in the purchasing power of money since the US abandoned or exited the gold windows in 1971, August 1971, when gold was at $35. Now the gold price is probably reflecting the cost of living increases between 1971 and today by rising strongly. That would be my view. But as you know, markets don't move in a linear fashion. They move up strongly, then they overshoot, then they correct for a few years, and then they resume their upward trend. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. That I wouldn't rule out. And equally, you know, if you ask me, Mark, you have to go to jail for 10 years. It's always a possibility. And then you have to invest your assets in one asset class and only one asset class. You cannot diversify. So you can choose properties, or you can choose stocks, or you can choose bonds, or you can choose gold. And you have to choose this and leave it until 10 years hence, 10 years later, when you get out of jail and want to collect your assets. In that case, what would you invest in? Stocks, bonds? I mean, I think gold would be a reasonable alternative. I mean, I've never been terribly keen about mining companies, but starting, say, about 9 months ago, I wrote that for the first time I was rather positive about mining companies because they were incredibly low compared to the price of gold, which had gone up substantially. The mining stocks hadn't gone up, but this year the mining stocks rose substantially. And I still like mining companies. I want to explain to you why I like mining companies. I think if you look at Barrick or Newmont Mining, the stocks have gone up, but they're not meaningfully up compared to previous highs. So I'd say this is a sector in the market. You asked me about value in the market, what it was desirable. I think mining stocks are very desirable. I think Barrick and Newmont, they can easily go up another 100%. I think US Treasuries is an alternative, not ideal, but say relatively favorable. And then cash is not a desirable investment, but it may be better than other assets in a downturn. You understand? You're not going to make money.
And it gives you optionality. You have optionality in case you have opportunity.
Yes. But my sense is that if everything goes down, I tell you, it will be very difficult for you not to lose money. But let's say everything goes down 50%. Like in the Depression, it went down everything 80% or so. In that case, you're the king if your portfolio only drops 20%.
Mm-hmm.
You understand? The market assets go down 80%. And you are among the fortunate ones where the asset value drops 20%.
Mark Faber points out that the dollar stayed strong until late 2014, mainly due to capital inflows, not fundamentals. Trump's policies weakened global confidence in the U.S. Meanwhile, the U.S. is in recession despite official denials. Recent analysis highlights that inflation remains sticky, with real interest rates often negative and underlying price pressures not fully reflected in official CPI data. At the same time, a weakening dollar, growing doubts about central bank independence, and geopolitical risks are driving investors toward precious metals. Gold, silver, and platinum are increasingly seen not just as profit opportunities but as safe havens and long-term stores of value. Now, let's just reflect on the interview.
The dollar has been exceptionally strong until November 2024. And it has weakened since then. And if you say, or if you argue that it was in the cards that the dollar would decline, then I agree. The dollar has been strong, but not based on fundamentals. It's been based on capital flows. In other words, the world moved capital into US assets, and so the currency remains strong. But I think Trump has done a lot to destroy to destroy the confidence people had in America. The bond market in the US should rally because we're heading into a recession. I think we're already in a recession, but of course, Trump and his henchmen will argue, no, we are doing extremely well. And the economy is exceeding expectations, and so forth and so on. But the reality is that if you look at the living standards of ordinary people, they're not doing well. No way. And the wealthy people, including myself and so forth, we benefited from asset appreciation and did very well in the last 30, 40 years. Ordinary people that have no assets, they've been hurt because the cost of living is going up much more than their salaries. So ordinary people get squeezed. And ordinary people is 70% of the US economy. There are instances where when they cut rates, the market goes up, and there are instances where it goes down, depending on the expectations that preceded the interest rate cut. But in the present situation, a 25 basis point cut wouldn't do anything. That is expected. 50 basis points, I think the bond market would react favorably, but not hugely. I mean, My view is the bond market will go and sell and trade until the yield on the 10 years is between 3 and 3.5%. Because I think the economy is much, much weaker than what the Trump team pretends it to be. Most people aren't doing well economically.
Mm-hmm.
Now, is Jeff Bezos doing well economically? Yes. There, say, 500 people in the US that do exceedingly well. Then another 10,000 people that do relatively well. And then there are zillions that don't do well.
Do you agree with Dr. Faber that gold is the most reliable long-term store of value compared to stocks or bonds? Could mining stocks like Barrick and Newmont really double in value if gold continues its upward trend? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.